the CLS Market Review for the week of June 9th, 2014. I'm Scott Kuby. Markets are sending a difficult set of signals to interpret. The economy achieved a set of major economic milestones this week, while key market and valuation indicators are suggesting the road ahead may be somewhat less smooth. The economic news for this week was very positive, as the economy produced 217,000 jobs in May. The data represents a major milestone. It is the first time since the late 1990s when job creation has been over 200,000 4 months in a row. In order to spur economic growth, the Federal Reserve has worked diligently to reduce the cost of borrowing for those desiring to take risks. Low rates may have encouraged complacency among investors after years of gains. This week, multiple Federal Reserve officials expressed concerns over markets being too calm. I would now like to welcome CLS analyst Sierra Morris, who follows long-term valuation trends at CLS and is the new host of our market review, to share some insights on price-to-earnings ratios.
Thank you, Scott. While not at an all-time peak, the current reading of the Shiller P/E ratio is at high levels compared to historical values. The long-term chart shows P/E ratios have climbed very rapidly as investors shake off the fears of recession and seek to avoid low interest rates on savings accounts and conservative investments, and instead pursuing higher returns.
Thank you, Sierra. The same optimism has shown up in recent low levels of volatility. Over the last year, the weekly standard deviation of the S&P 500 has been just over half the standard deviation in the previous 9 years. Near-term estimates of risk are also low. The CBOE Volatility Index, or VIX, fell below 11 for the first time since February 2007. So how should investors react to this information? I believe investors get paid in the long run for bearing risk, especially risk other investors are anxious to avoid. While the economy suggests things are improving, investors aren't getting much reward from their fellow investors. Based on behavior, investors are optimistic, maybe too optimistic. At CLS, we continue to expect bigger market swings. The last 12 months have been some very calm seas to sail on. We encourage you to make sure your risk budget is in line with your objectives. While we still expect to make progress, we expect the journey to get a little rougher. So, Sierra, if Mr. Harwell were here, he would feel his brief appearance would entitle him to close the show. So would you like to send us out?
Oh, I'd be happy to, Scott. Wouldn't want to disappoint our favorite chief investment strategist. That concludes our update for the second week of June. We hope to see you back next Tuesday. Have a great week.